I'm here with Neil Johnson, CEO of Duke Royalty. Hi Neil, thanks for joining us.
Thank you.
Now, Duke Royalty became a portfolio company within the Downing Strategic Microcap Investment Trust in 2018. And what we really like about the business model is the high level of revenue visibility that comes from 30 plus years commitment from their royalty partners. That together with a highly proven and well-experienced management team means that there's a good capability internally to execute on the strategy. Now that all leads through to a very highly cash generative business model that will lead to a progressive and high dividend paying business. So Neil, thanks for joining us.
Thank you.
Can you tell us a bit about yourself and how Duke came into being?
Right. Well, James, I was 20 years experience at Canaccord Genuity, was 10 years living in London and heading the corporate finance department. And really, as a Canadian, our business model in the early years when I was here was taking Canadian businesses and dual listing them in London. Through that experience, I realized that there was this royalty industry that was a very investable and high growth area in North America that had not been taken to the UK stock exchange yet. So I left Canaccord, I founded Duke Royalty. I have a chief investment officer, Jim Webster, who has 25 years of experience in royalty investing. I teamed up with Charlie Brooks, who heads our UK operation. And there's 8 of us now that have started Duke Royalty and invested 12 different royalty partners.
The royalty finance model is something that's quite new to the European market. Could you just talk us through the headlines?
It is an alternative finance solution for owner-operated businesses that provide a non-dilutive solution that also does not carry refinancing risk. So think of it like a corporate mortgage. It is paid over a long period of time. Once you're paying us, we provide the lump sum of capital upfront. And over a long period of time, and these are 30-year agreements, you're paying back the principal and an interest to us throughout the term. But at the end of the term, there's no further obligation. So that's where there's no refinancing risk for the business.
You mentioned that the agreements for 30 years plus. That's a very long period of time. Do businesses really plan for that?
Well, it's all about actually keeping the control of the company in the hands of the business owners. So there is a buyback, just like your house mortgage. You don't have to stay in your house for 30 years. You can move and repay the mortgage. So if you sell the business or you want to refinance us throughout the 30-year term at any time, you can do that. But just like your mortgage, you're going to pay the principal and a prepayment penalty.
So Neil, perhaps you could talk us through some of the economics of one of these royalty agreements.
We have a 13% cash-on-cash yield. So, for example, if an investment from us is £10 million, we would receive £1.3 million the first year on a monthly basis, and then that continues over the life of the royalty agreement.
And there's an interesting reset mechanism. How does that work?
Well, the term royalty is that it is not exactly like a loan. We're not a bank, and we don't participate in the equity, but we do participate in the economic growth of the business. So what we do is we reset the amount that is owed to us every year based on the growth of that business from the previous year.
What do you think the key elements of the investment thesis for Duke Royalty are?
Well, I think royalty companies in general, and us specifically, are good investments because of the high visibility of the revenue stream. We're locked in for 30 plus years on every one of our contracts. The second point, I would say, is the high operational gearing. We have a fixed cost base. There's only 8 employees, and we can continue to grow with the same amount of people. The third is that we have a dividend policy, and we pay quarterly dividends. And the fourth is really the accretiveness of each of our additional royalties that can give the investors an increasing dividend as time goes on.
Okay, so because of this fixed cost base, which is actually quite different from the fund structure that investors might be familiar with, then all of the incremental revenues fall straight through to the bottom line as an increased free cash flow, which allows the dividend to grow over time.
Absolutely, and that's why we are in a company structure, just like dozens of companies in the North American public markets.
So how big is the market opportunity in Europe?
Well, actually, from the North American point of view, there's 50 billion pounds of invested capital in all sorts of different royalties. It really started in mining and oil and gas, and drug royalties are also a big royalty. And what we do are corporate royalties that really have not come to the European market yet. And so we think the market opportunity here is huge. And for the first mover advantage that we have in the UK and across Europe, we really think that we have a great response from small to medium-sized businesses so far.
So can you talk us through the market opportunity for Duke Royalty?
Right. Well, James, what I'm attracted to is that is a very well-established product and invested industry in North America, where there's about $50 billion of invested capital in all forms of royalties, and it's been around for decades. There's dozens of public companies in North America, but we're really pleased to be the first that have listed in the UK. And so when we talk about what we do in corporate royalties and in this alternative finance to small and medium-sized businesses, there really is no competition. We're the only listed company, but we really have an open opportunity in the UK and Europe that we think is as big as North America.
So very little competition in this space then?
Well, that's true. We are the listed competitor, and actually, James, we just acquired our only other competitor called Capital Step that had a small portfolio as well.
And what led you to make that acquisition?
Well, we knew about Capital Step and what they were doing. They were investing a little smaller check size than we were, but on the same criteria basis. And the participating element of their investment strategy really led us to realize that if we combined our forces, we would 1 and 1 equals 3.
With the participation element, can you explain that in a bit more detail for us?
Right. So we talked about year one that we would have a 13% cash-on-cash yield. And we are not just like a lender. So every year, our participation and our cash-on-cash yield that we get will go up and down with the revenue of the businesses. So that's collared up and down 6% from the value that we received based on what the revenues were the year before.
I see. So if you find attractive business models that are able to grow in their end markets, then you can experience growth in that return that an investor would see within the business.
That's what we're looking for. We're looking for companies that slowly grow and are mature companies. We're really looking for long-standing, profitable businesses that are owner-operated. And that's key for us in terms of our criteria. But we give them the capital to keep growing. And then we participate on a compounded basis every year. And so it's a win-win for the owner-operator. They keep control of their businesses. We provide embedded growth for our shareholders as we continue to look to grow our own firm, both by new royalty partners and by growth within each investment that we make.
And the Capital Step acquisition has been a fantastic way to accelerate the diversification of the Duke Royalty portfolio. How do you see the portfolio evolving over the coming months?
Well, in the last 2 years, we've got 6 royalty partners on Duke's side, and Capital Step, from a similar starting point, also had 6 royalty partners. So now we have a portfolio of 12 on a combined basis, and we think within the next 12 months, we get that up to about 20 different companies.
Well, of course, these are operating businesses, and due diligence is very important. I think it's fair to say that we're getting increasingly late in the cycle, and people are placing even more emphasis on operating performance of businesses. How do you protect on the downside within the portfolio?
Well, we spent a lot of time thinking about that. We have a very robust due diligence process. We also have an independent investment committee that is distinct from the board, that has this type of risk analysis built in to our process. We look for companies that have been around for multiple economic cycles, that the owner-operators have both owned the companies and have managed the companies through good times and bad. We also have senior security, so we are essentially the bank, and all these owner-operators would lose everything before we lost a dollar. We also have cash flow coverage as well. We want to take whatever payments they're making us, we want them to make a bigger payment for themselves. So things have to go very wrong for something to be in trouble. And we're looking for companies that management doesn't want to sell. You know, we believe that control in the management's hands and the owner's hands, they're the best ones to run the business, and we're a passive investor. As I say, you know, we're taking a little bit of risk with the business through our participation up and down every year.
Would you take other additional protections that you might see from a more traditional private equity type model?
Well, we have all the security over the business and share pledges. And if there are assets like on our riverboats, we have the first mortgage over the riverboats. But you know, it's a non-dilutive solution, so we're not taking seats on the board unless there is a problem. But we're letting the companies run their businesses the way they see fit.
And the royalty payment coverage is a very important element of the protection. How is the portfolio positioned currently in that respect?
Well, we're looking for 2 times coverage ratio for our royalty payments. So as I said, you know, if we have £1 million, then the EBITDA of the business has to be £2 million or more. And so we always want to take a minority of the cash flow of the business, so be a minority partner in that way. That gives us a lot of buffer to make sure that the owners of the business still have their dividends, that they pay their school fees and their holidays and whatnot. And it's a win-win for both of us.
And so because of the lean operating structure within Duke, it would be fair to say that that provides a good level of protection to the underlying dividend that investors in Duke Royalty itself would receive.
Yes, absolutely. We have monthly management reports from every one of these companies. We again go into companies that we provide the growth capital. So, you know, early years, we've had positive annual resets on the first 3 companies that we have reset. So everything is looking positive.
And that's a really key point, isn't it? Hitting those early resets at the ceiling level of their potential can really help to generate long-term returns for Duke and for investors.
It helps, so they're happy because they've got the growth in their company, and we participate. But everything over 6% is really to the business owner. So the alignment of our interests and their interests are parallel. And I think that's what's missing in bank loans these days. The banking crisis has really put a funding gap for the SMEs. The banks themselves have higher capital requirements for lending risky businesses. So they're focused on the businesses that don't need that loan. That's where they want a loan. And the banks have an issue, have the credibility issue. They right now on the small to medium sized businesses, what we find is high street banks and mezzanine loans that we do compete with. They have principal repayments throughout the term. So you can get a 5-year loan, James, but you have to pay back that principal 1/3 of that amount in years 3, 4, and 5. And so it really impinges the cash flow of the business owner.
So that places an incredible cash flow constraint on, or restriction on the ability of management to reinvest in their business and grow for the long term.
That's the beauty of our model is that, you know, you're paying a small amount of the principal, but it's the free cash flow to the business owner in the first 5 years. And let's face it, that's as long as a business is realistically looking out. But they don't have a refinancing risk. And if there's an economic downturn, you know, everyone remembers 08, 09, 10, where they couldn't refinance their loans. They don't have that issue with us. So actually the late cycle that you mentioned really is a benefit to us because people are afraid of risking their business. And they don't have that with us.
So you have first mover advantage. You've acquired the only real competition that you have in the UK. Are you experiencing much demand for royalty financing from European SMEs?
That's a good point. And we don't need to do 100 transactions a year. As we said, you know, we protect our downside. We do a lot of due diligence. We actually have management consultants that help us in each specific industry, because we can't be experts in all industries, but we do have partners that help us do our due diligence. So what we find is there's specific instances where royalty finance really shines, and that is for owner-operated private companies that they have an acquisition that they'd like to make, but they don't want equity to be given. So acquisition financing is accretive to them and a good use of our capital. Also shareholder restructurings. If there's minority shareholders that want out, but the principal shareholder and driver of the business doesn't want to sell, this is his business, he can use our capital to give them an exit. And then he's still in control. And MBOs, things like that, and debt refinancing is also one of the things that we've found is really attractive for our alternative financing solution.
Okay, so no shortage of opportunity then, but I've noticed that you've also done some follow-on tranches with existing royalty partners in the past, which has an interesting knock-on the reset mechanism.
Yeah, it's a good point, because one of the features that we say to our royalty partners is if we want to keep growing with you, as long as there's an accretive acquisition or your business is growing, we want to grow with you. And that's the secret of being a public company. We have permanent capital, and we can now be long-term partners with our royalty partners. And so these follow-on investments are the same return, but a lower risk, because we know the companies, and that just bolsters our ability to reset on an annual basis our payments.
Corporate governance and shareholder alignment is a key element of investing in smaller businesses. How do you go about ensuring that the management team is aligned with shareholders over the longer term?
Yeah, alignment is key for us. As I said, we're aligned to the management of our royalty partners. We're also aligned to our shareholders. So management owns 10% of the company. We have invested alongside every institution and every placing that has taken place, and significant sums. It's a significant portion of each of our net worth. And so we want to be shareholders, and we are big shareholders, and that drives the alignment with everyone.
Yeah, it's great to see when management are prepared to put their hand in their pocket with hard cash, but also having a long-term incentive plan in place is critical to driving value over the medium and longer term. Have you got anything in place for the current management team? We do, and we're a small group of managers. So what we have in place is, just like every AIM company, is a long-term investment plan that is only performance, and it's 100% stock-based, and it's a 3-year vest.
And our performance criteria is increasing the cash flow and the total shareholder return per share. So we need to make shareholders money before we get any of our long-term incentive plan.
So as we look out over the longer term for Duke Royalty, how do you see the business evolving?
I think we continue to increase our royalty partners. That's the big opportunity for us, being the only one in the UK and the European market today. So we build on that first mover advantage. I think we have the team to do that. We have 12 royalty partners right now. We'd like to double that in the near term without adding any other overhead, which really increases the free cash flow, which is a key tenet of the investment thesis of royalty companies. And therefore, when we do that, we can continue to increase our dividend. We've increased it twice over the preceding 12 months, and with a bigger portfolio, we can continue to do that. And I really think that with our management team, our royalty experience, and our first mover advantage, we have a great future ahead of us.
Well, thanks so much for coming in.
It's a pleasure, James. Thanks.